have joined WealthCon. Today I'll be talking about investing in the exchange traded funds. ETFs means exchange traded funds. So what are exchange traded funds? Basically, they are mutual funds, but not exactly mutual funds also. Because for a mutual fund, you have to either go on, we never recommend going through an agent, definitely not. But you have to go through a fund house. You can invest in direct mutual funds through a fund house. But still, there is a fund manager for each mutual fund, and which gets sequentially managed by them by or reorganizing, rebalancing the portfolio depending on how the market is moving. Sometimes they throw out few stocks, take in new stocks. You do not have any control on them. But historically, it has been seen that many mutual funds fail to beat the index. If they do not beat the index itself, then what is the point in investing in a mutual fund? Now, what other options do we have? Now, investing in individual shares carries its own risk that tomorrow the company goes bonkers. Like when, for example, I'm not here to badmouth any company, but if you take an example of, say, Yes Bank, which was rising very well, but then suddenly some management issues happened, and now the stocks is being sold at pennies. So even such kind of things can happen when you're putting your money in certain stocks, and then that can cause a huge amount of loss, which you need to take it in your stride. Sometimes it causes a lot of tensions and everything. This is the reason why many of the mutual funds also fail to beat the index, because the money managers, they do not really care about how or what your money is going to do. They are bothered about their fundings, their own expense, their own income, because whatever expense ratio you're paying, whether the market is going up or down, they keep getting their income from it, from the percentage of whatever they're charging, they keep getting it. I'm sorry. So this is the reason why many of the mutual funds, they fail to beat the index as well. Now, this screen shows certain numbers and figures where you can see that a lot of funds, they fail to perform as better as the index does. So what is the option do we have? We have what is called as the exchange traded funds. Now these are type of mutual funds which directly invest your capital into the index itself. Now what is index? Index is Nifty or Sensex or commodity. So these are the exchanges, the National Stock Exchange and the Bombay Stock Exchange. So directly on the exchange, whichever constitutes the index. Now Nifty 50 means the top 50 performing companies which form the Nifty 50 index. Then the Nifty next 50, that is from 51 to 100. Then comes the mid cap, that is 101 to 250. Then comes the small cap, that is 251 to next till the 500. So this is how the index has been divided into large cap, mid cap, and small cap as well. So the exchange traded funds directly invest your capital into these constituent companies. So really you do not have to worry about which company you're investing in. Some companies which are performing, they come into the index, and some which are not performing, they get thrown out of the index. So automatically your money keeps rotating into those constituent companies which are forming that index. So that is exchange traded fund. The other part of exchange traded fund and the mutual fund is, for a mutual fund, you have to go through a fund house. So first you have to either open up, say, a direct an account in mutual fund utility, or there are certain brokers which allow direct investment into the funds as well. But then your funds are taken in, and then they're processed, and then an NAV is allotted to you. This takes about 1 or 2 days. But the ETFs, the exchange traded funds, are bought and sold like shares. Like you search for a share, like if you want to buy a Reliance share, or if you want to buy Tata Power or Tata Motors or Mahindra, whatever company shares you want to buy, you enter, you see, you buy, and the share comes into your demat account. So the process of buying the ETF is the same. You just search for the ETF, name of the ETF, Just see how much, whatever the price or whatever the quantity you want to buy it for, enter, and then the ETF comes into your account.
లోపలే
So
కూర్చుంటాం
this is managed passively by the company which is this managing the index fund as well. So these are different. These are basically totally passively managed funds where the fund managers, they do not try to outperform, but they just keep mirroring the performance of what the index is. If the index is going up, your ETF performance goes up. If the index is going down, your index performance, I mean the ETF performance also goes down according to that. As with any fund, Wilcon recommends that we do what is called as a control R analysis for ETFs. Now, when we compare the ETFs with other funds, we find that the cost of doing business is very cheap as compared to the mutual funds. The cost of doing the business with ETF is very cheap. That is the expense ratio. Expense ratio means anything which is charged over and above what you're paying for managing that fund. And it is charged to you only. It is not the company which is going to pay. So the expense ratio is very much less. Tax according to any equity for equity, this thing, it is taxed according to the equity tax laws. That is the capital gains. Less than 1 year is short-term capital gains, more than 1 year is the long-term capital gains. And the liquidity is very good. Liquidity is basically the ease of doing business. Now, certain times, for example, like if you take an example of real estate, the liquidity of the real estate is very much less. That is, when you want to buy and you want to buy it at a particular price, you won't get a lot of options in that area which you are looking at. Or if you're owning a land and if you want to sell it, you don't find a buyer very soon. So this is called as liquidity. The real estate has got very less liquidity. So, but that thing is not seen in an exchange traded fund. The transactions are very much liquid. Today, if I want to buy 1 lakh rupees worth ETFs, I'll be able to buy immediately. Not today, I mean today is Sunday, of course, but when the market is open, I can buy as much of funds I want to buy for 1 lakh rupees easily. There won't be like 1 lakh rupees, I have to wait 1,000, 1,000, 1,000. No, like not like that. So the liquidity is not a problem. Risk. Now the risk of an ETF is equal to that of the risk of an index. Now we know that even in the worst of the times, like in COVID crisis or even during the World War, the index never became zero. So the exchange traded fund, which is mirroring how the index is behaving, is also not going to become zero. So your money is technically safer. I wouldn't say it is 100% safe, but technically safer. Unlike a particular stock, which you enter at a very high price and then suddenly the company goes low, the company goes bonkers and your money, your stock prices keep falling. You keep losing the money. It can even become zero. And that scope is not there in an index fund. Secondly, if there are companies which are not performing, they're thrown out of the index. And some other company which is performing better is taken into the index. So the top 50 means your money will always be invested in the top 50 companies only. So that risk of losing money is also very much less. Returns are same as that of the index itself. Like if Nifty has given 15%, your Nifty Bs, that is ETF portfolio of Nifty 50 only, will give you 15% only. If Nifty gives you 10%, it's going to give you 10% only. So you might be asking, what is the fun in investing if I cannot beat the index? If it is same as the index, the other mutual funds, I mentioned that they don't beat the index, and this is also not beating the index. Then what is the use? We'll discuss about that in further slides. Before that, we'll see what kind of ETFs are available for us in the market. There are something called as equity ETFs, then bond ETFs, which are liquid funds, and the commodity ETFs. So the ETFs, equity ETFs are the Nifty Bs, Junior Bs, Bank Bs, Mid 150s. Even you have ITBs, sectoral indices like Pharma Bs or ITBs also. Pharma Bs is those companies which are forming the pharma sector. ITBs is those companies which form the IT sector. Similarly, Bank Bs is companies which are forming the bank sector. Now, why we are only talking about Nifty Junior Bank and Mid 150 is these have got maximum liquidity. Ease of doing business is maximum in these. The expense ratio is also very minimal, and the diversification is very good. Lesser the company, lesser the diversification. More the companies, more the diversifications. Bond ETFs are liquid funds, like liquid ETFs. They go according to the 1 day rate of Nifty. So they invest in liquid funds. So they don't give you more returns. They hardly give you about that much, whatever the savings bank is giving you, around 4 to 5% per annum. But that is for safety. Like, it won't create wealth. It will be protecting wealth for a short term. You cannot put all your money in bonds ETF, or you cannot put all your money in equity ETFs. There has to be a balance maintained. And then there comes the commodity ETFs, the gold bees and the silver bees, which go according to the gold and silver rate of that particular day. The up and down, whatever happens, it happens according to that. So these are the indices which these particular funds represent. The Nifty Bs represents the Nifty 50. The Junior Bs represents Nifty Next 50, that is 51 to 100. Then from 100 to 100 to the next 150 is mid 150 Bs. And there is MON 100, which is investing in the top 100 companies listed on the Nasdaq index. So we can divide our investments into all these indices. So there's an adequate diversification even across the countries. Some people, they say that I want to invest in US market. 100 is a very good option for that, because that allows you to invest in top rated US stocks without actually having to open up a demat account in the United States. So must be asking, what is BEES? BEES is just an acronym for Benchmark Exchange Trading System. Now, if you translate that exactly into this thing, it will become bets. But the bets sound so bad, but BEES sounds better. So that's why they have just mentioned it, made it as Benchmark Exchange System, but it is basically Benchmark Exchange Trading System. The ETFs are managed by a company called as Nippon Asset Managing Company. So the unit of 1B is approximately 1% of that of the underlying stock. So if Nifty is trading today at 23,000, the cost of 1B would be will be 230. But it will generally be little more. It will be around 240 or 245 like that, because that has considered all the dividends which have already been included, but the dividends which the companies are paying out, the constituent companies of the 50, so they get included in the price of the B. It was introduced in the year 2002. The analogy what we can provide, considering that we are in the medical field, ETFs are generic and mutual funds are branded. So whenever the brand comes, there comes extra costs. But action wise, both of them are same. Many times the generic medicine works better than the branded medicine. So we are saying that if you have adequate knowledge about how to invest in mutual funds or how to invest in individual shares, or if your risk taking capacity is good, you can definitely choose that. But if you do not have a lot of time to do studies, if you cannot spend even 5 minutes, I'm saying it's literally, if you cannot even spend 5 minutes, then ETF is the best options for you. This particular chart includes what and why and who and what about the entire ETF. Now, we are saying that any investment has to be for long term. Long term means minimum period of 7 years. 7 years is the minimum period which you're looking at an investment. If I put my money in right now, I do not track or what happens to that money tomorrow or day after or next month or even next year. I wait for 7 years by following something called a particular way of investment, which again I'll be detailing. It is not recommended that you invest in equity market if you are over and above 60, because your goal beyond 60 should be capital protection rather than capital wealth creation. Wealth protection should take priority beyond the age of 60. But until the age, but it is not a hard and fast rule, it is just a guideline. Like if you are expert, I mean, nobody's an expert in the market, but if you have the risk-taking capacity, there is no stopping you from investing even beyond the age of 60, but these are just recommended guidelines. Those people who do not have a lot of risk-taking capacity, if it is medium to low, maximum, like I don't want to take a lot of risk, ETFs are good enough for me. And if your goal is wealth creation, not just wealth protection, again, if you do not have any experience, it's absolutely not an issue because ETFs are best suited for people who do not have any experience in the market as well. The strategy for utilizing the ETFs or investing in ETFs, the best way is to do SIP and buy on dips. SIP is systematic investment plan and dips is buying on dips. Now, what is SIP and what is DIP? I'll just explain. Just give me one moment. Just give me a moment. So sorry for the disturbance.
James really thriving, working with back to the skyscrapers. I think we've seen so many teams to counter punch to attack.
I'm extremely sorry. There was someone at the door. So yeah. So I was discussing about the SIP and the buying on dips. SIP means systematic investment plan. That is investing on a particular day of every month, regardless of what the market situation is. You are not timing the market here. So if you decide that on the 4th of every month, I will invest such and such amount in a particular ETF. So regardless of whether the market is up, down, or whether your investment is in red or investment is in green, you invest a particular amount. Like 1 lakh rupees, if I have decided to invest, I will invest 1 lakh rupees. That is systematic investment plan. This way, what happens is when the market is up, even though you're getting less units because the NAV is high, you get less units. But when the market is low, you get more units for the same amount of money. So what this does is it averages your buy price. Averages your buy price means every time you're buying, your buy value keeps getting lesser and lesser, lesser and lesser. You cannot go down to completely zero. It is an averaging of the buy price. Like today, if I have bought for 100, tomorrow if the market goes at 150, the 150 units, the units which I'm buying at 150, I'm basically buying at just 125. Even though I have bought few units which were already 100, they have become 150 now. But when I'm buying the 150 worth unit, it is for me it costs only 125. So that's how the prices gets averaged. This is SIP. And what is DIP? DIP is dips. Now, if you can see on this screen here, the market is going up, coming down, then going up, coming down, then going up, coming down, then going up. So this is how the market keeps moving in up and down cycles. So what happens is, suppose if you have started a systematic investment plan, you bought on this day, then the market has gone up, then 1 month finishes, then you are here, then you bought again, then 1 month finishes, then you bought again here, then 1 month finishes, you bought again here. Now, after that, the price has fallen down again. Okay, if the price has dropped significantly for say about 5% or 10%, or even 2%, 1%, 2% is a big fall in Nifty currently with its rate at 23,000, but still, say if the price keeps dropping like that, so for every 5% or 10% fall, you can add a little more other than what your monthly amount is. Like suppose my investment is that I should be investing regardless of the market, my SIP should go on 4th of every month. Now fourth, I invest. Then I see that around 14th or 15th, if the market has fallen down and I have little extra to invest in. So I add it in the same ETF in the same ratio. So that is called as buying on dips. This is how the prices get averaged, and you can actually beat the index by staying in index only. Now there are people who might ask, why not only buy on dips? Why only keep doing SIP when we can buy at a lower price also? That is because we can never time the market. We don't know which dip is the dip. Now, if we consider the same thing here, okay, on the same side, if you consider the same chart which I'm showing, okay, I consider that this becomes a dip here. Okay, now I feel that okay, the market is falling anyway, so it will keep falling further. So I keep waiting for the further dip, but that never comes. Then the market keeps going up, and I have lost 2-3 opportunities to invest at the investment dips. So the dips should not be made as a priority. Dips are addition to SIP. SIP is a must. One of the very good analogies was given by our Makran sir, that a person looks good in a shirt, in a full suit and a tie also. So the full suit and shirt is like SIP and the tie is like DIP. It would look very crazy if a person only comes out wearing a tie and not wearing the suit at all. So, but the person can come out in the suit without wearing the tie. That's not an issue. SIP can continue. DIP is an addition which will increase the value of your investment, just like the tie increases the value of a person wearing a suit. Now, how do we choose ETFs? Which ETFs are good, which ETFs are bad? Again, the CTRLL analysis is always there. This is just a pictorial representation of that. You see that the expense ratio has to be minimal, liquidity has to be maximum, tracking error has to be minimum. Now, what is tracking error? Tracking error is just the difference between the returns of the index and the returns of the fund. So sometimes if it is too big and if it's on the lesser side, then definitely that is not a good choice for investment. And you can see this screen, the screen below shows a screenshot of Nifty Bs. This is actually when the market has closed. That is why you're not seeing any numbers on the red side. But here you see the volume price, volume. We actually do not see, but this is just to show how much of a volume was traded. That is almost 56,60,999 units were traded. So that kind of a volume is required, which will generate a good liquidity. So all funds should have extremely good liquidity, least expense ratio, least tracking errors. When you look at advantages and disadvantages, the advantages of ETF score way above the disadvantages, because you don't have to worry about diversification. That happens automatically. Cost is not an issue at all as compared to other funds. The expense ratio is very bare minimal. Flexibility, just like shares, it can be bought and sold anytime you want. And it is also tax efficient because it does not have the exit load of 1%, which most of the funds carry if you exit within 1 year of time. That is, apart from the short-term capital gain tax, there is a 1% extra additional load of your folio size, which you have to pay if you are exiting a mutual fund. The ETFs, generally they disclose their holdings on a daily basis. It is all available on the respective websites. And as I mentioned, the tracking error and the liquidity tracking error is very less for the ETFs, as well as liquidity is extremely good. So the advantages are much more than the disadvantages. But of course, there is a certain chance, or you can say a possibility, that certain shares, they become multi-baggers. Like you take, for example, Maruti, which started off with few hundred rupees, is now trading at tens of thousands. So such kind of things you will lose if you are sticking only to ETFs. But that is just a possibility, but the probability of every share becoming like that is very low. It is just a matter of luck, pure luck, whichever share sometimes you're owning, suddenly they become multi-baggers, and sometimes that share alone can literally sponsor your entire retirement, your life, your next generations as well. Sometimes it happens, but that's purely a matter of luck. But that is, as I mentioned, low probability. But with a consistent performance, ETFs, you can definitely beat the entire such kind of happenings. If the time permits, after the presentation is over, I would like to show one Excel sheet which I have created, in which you can easily calculate how much SIP you want, and you can even do a reverse calculation as to if I want a particular amount to be done after a particular time, how much SIP I should begin with. Now you can see this chart shows the return comparison of Nifty Bs along with that of the Nifty 50 index itself. You can see that the chart is totally symmetrical. That is, it just moves just like the index. So you really do not have to worry. This is what we are talking about, that the risk is equal to that of the index itself. Now we know index is not going to become zero. This is the COVID dip here. Even during the COVID times, the index has fallen only 40%, not beyond that. And even during the 2008 crisis, the index did crash, and the maximum it crashed was 60%. Again, this is junior B's returns. As you can see, it follows the price of that of the index, Nifty Next 50. So this is a comparative slide, comparison between the ETFs and the mutual funds. You see that the fund manager is not required for ETFs, and that is why the expense ratio is less. The fund allocation and redistribution is all passive, and the expense ratio of a mutual fund is higher only because these things, the fund allocation, the redistribution, all these things, they are done actively by a mutual fund manager. That gives them that extra income. So basically, that's the reason they do it. None of the mutual funds are traded on stock exchange, unlike the ETFs. So I think I'm just hammering the same points over and over again, that the expense is less, the management is easy, and there is no cause of worry and all those things. So even large cap mutual funds, what we call as a blue cap mutual funds, sometimes have underperformed that of the index, but ETFs do not have that kind of a performance. You can just check all the upcoming slides. You can just keep an eye on this figure, the XIRR, that is the extended internal rate of return. Now, even if index has given about a historical return of 12%, your XIRR for Nifty Bs is 21.81%. That of junior Bs is 58.35%. Mid 150 is 35.54%. This is the ETF portfolio returns of one of our colleagues in WealthCon. And these are the dates when he started investing in Nifty Bs, junior Bs, and all those things. With the absolute returns, that is absolute gain in the wealth invested in Nifty Bs of 55.17%, that is cumulative. He has got an XIRR of 20.4% per annum. 20.4% per annum is a big deal, a huge deal. There are people who promise you in the market that we give you 30% returns. They are liars, because only two people can give you 30% returns, more than 30% returns. One is God himself, and the other person is a liar, because nobody can give you 30% returns. So there is no point in falling for such a trap. But if you manage your portfolio the way many of the doctors in WealthCon are managing, by sequential investment, by doing SIP and adding on dips, we can see that the figures of 30% are easily met. We are not liars. These are actual figures from our colleagues only. But it's like you cannot invest everything in a single basket. If I invest everything in one, I can get 43%. People might be thinking, okay, then why not invest everything in one? But if I do everything here, I lose out on all these cumulatives. But when I take the average of all these things, my portfolio will definitely give me more than 20% returns. Now keep this figure in mind, more than 20% returns. Just keep this figure in mind. We'll discuss why this figure is important. So if a fellow doctor can do it, why can't you? Why can't I? So this was how I also joined and how I also started. Why can't I do it if my fellow doctors can do it? Here, I would like to just take a couple of minutes in talking about how foolish I had been. I had joined WealthCon when it was still a baby. I had joined it when it was still on WhatsApp group. It was around 2018, I think 2017, 2018. I had joined it on WhatsApp group upon insistence of one of my friends who was discussing about this group. And I just joined it for the sake of joining because I didn't know what to expect. After some time, what happened? I was talking about my investment. I had invested in an apartment at that time. So I was talking about that. So I think one of the seniors had messaged that what I have done is wrong. It is not a good investment. But that I took it on my ego. I said, he is also a fellow doctor, not a money manager or something. How would he know about this thing? And why he is talking about what I have done is bad. I exited that group like a fool. Then finally in 2021, when the COVID second wave happened, when I was forced to be in lockdown after I traveled and was turned positive for COVID, I was forcefully asked to, because I had turned positive, even though I was not showing any symptoms, I was locked in a room, hotel room for 2 weeks straight. I couldn't go out of the room. That is when I just joined WealthCon again on Telegram. And at that time, I went through all the messages of Goldmine channel and realized what a big fool I had been. I had lost 3 years of my life doing nothing. And on small egoistic problem, I just lost 3 years. I could have made a killing during the COVID if that happened. But anyway, I joined, then immediately I did my BIC. Then I did my AIC. AIC was a thing then. And after that, I joined TMB. And things just happened that after that, I got a chance to become a guide, then a senior guide. The more I am interacting with other doctors, the more knowledge I am also gaining in this field, and the more confidence is building in me. One of my friends asked me to join one of these multi-level marketing schemes of QNet. Now I dissuaded him. This was before I joined WealthCon, and I had almost paid him that 4 lakh rupees, but I somehow senses prevailed and I did. And after I joined and I finished TMP, I showed him what the real truth is, and I made him join the TMP. Now he is also senior guide, teaching other doctors, and he's always thanking me for taking me out of that QNet. The best part of this is, the person who had asked him to join QNet was his own cousin. Why I'm talking about this was his own cousin. And since he couldn't continue it further, he paid for his cousin's 4 lakh rupees because he had made him join that. He had made his cousin, and the second person was supposed to be me. I didn't join, but his cousin had already listened to him and joined. So he took it upon him that he has quit. And he is now doing this. So he quit it. He quit QNet. He paid his cousin the amount which the cousin had paid him. And now he has taught him what SIP and DIP is, and his cousin also doing very well now. This is how the community of doctors is helping other doctors as well as their own family members. Why? And it's very easy, as I mentioned, creating an SIP order. Just go to the search column of any of your brokerage platforms and search for these words, Nifty Bees, and look for Nifty Bees from Nippon India ETF Nifty Bees, that is trading on the NSE. You enter the amount or the quantity, whichever, but it is ideally recommended that you enter the amount only, not quantity, because quantity becomes fixed. When the market rises, you get less quantity. When the quantity is fixed, your amount keeps changing. Like if I want only 100 quantity, and if the Nifty Bees is trading at 240, then I'll have to pay 240 into 100, that is 2,40,000 rupees. Is it? Yeah. 24,000 rupees, sorry, 24,000 rupees. But the market goes up. If Nifty Bees price goes to 250, then I have to pay 25,000 rupees. If the market comes down to 230, if the price comes down to 230, I pay only 23,000 rupees. But here what happens is your amount is not fixed, but always you should be fixing the amount. Like if I want to buy Nifty B is worth 25,000, I should be entering SIP amount of 25,000 here. So that way the quantity gets changed, but the prices get averaged. And you can select the SIP frequency as monthly. Weekly is not recommended. Monthly is fine, generally during the second or the fourth week. For a marginally better returns as compared to first or third week, we don't exactly know the reason why, but it has been observed that way. Then once you've entered the amount and you have entered the date, you just fix it and then confirm, and then your SIP is started. So to summarize what we've learned today, it doesn't take a lot of time in learning how to do an exchange traded fund investment. And it's not required for you to time the market at all. Just invest by SIP and DIP method in an ETF, and your investment journey can begin tomorrow itself. On Monday, you can start your investment journey. If you want to study more regarding the shares and other mutual funds and everything, definitely you're welcome to join WealthCon as a platform. I'll be sharing the number at the last slide. I'll be sharing the number. You can take down that number and send a message, a hi message to WhatsApp. They'll definitely let you join the group. And only MBBS doctors, of course, are allowed to join WealthCon, which is the norm. Non-MBBS doctors are not taken in at all. Why we should be learning finances as doctors is that as compared to any other profession, our profession carries a lot of privilege in which we have that kind of power, we can say, to violate a human body's integrity, to set something right, which is going wrong in their bodies. So that kind of privilege not everybody has. But many times that privilege gets abused and, for want of money or anything. But the larger picture is that if we all work for passion and get paid actively and make that money work more for us, there is nothing better that we as a group can do better for the society as a whole. And financial independence is the key for every doctor. Finance is a 7th grade subject, so we should not be worrying about why we should not be able to start it. Because if we do not find a way to make money while we sleep, then we'll have to keep working until we die. This is what Warren Buffett has mentioned. But this is the number which I was talking about, 9644329999. Please take down this number. I'll also SMS this number in the group, which can be forwarded to any of your fellow doctor colleagues to help them join WealthCon, and then we can learn a lot more than what I have just talked. This is just a swift and fast presentation because we don't have a lot of time to discuss each and everything today. Sir, I'll just be taking 2 more minutes. I'll just show the SIP calculator sheet, which I had prepared on Excel. So for example, that if you start with a monthly investment, so most of us, if I can consider an average age of 40, and you're considering that you are going to invest until the age of 70, that is 30 years of investment time. So if you start off with, say, monthly investment of 50,000 rupees only, with a rate of return of 12%, that is minimal, and we have 30 years to go. So with a 50,000 rupees investment on a monthly basis, this is not accounting for addition on dips. This is purely SIP only. If you add on dips, you can definitely get much more than what the value figures here. So with a just 50,000 rupees, with an annual rate of return of 12%, you can make 176, what's that, 176 crores. No, is it 17 crores, 64 lakhs? Yeah, 17 crores, 64 lakhs with an investment of 50,000 only. Now, I told you, just remember that figure of 20%, which is a cumulative 20% returns when you diversify. Now, if I increase this 12 to 20, you just see what figure changes in this final value. It becomes 116 crores. From 17 crores, the figure has gone up to 116 crores. And this, I am talking about a monthly investment of 50,000 only. Now, if you increase the same figure to 75,000, which is, I think, very much possible, the figure goes up to 175 crores. I have inquired amongst my fellow colleagues, many of the doctors are doing a monthly SIP of 1,50,000. So if I take that figure, this becomes a 350 crores. And I have mentioned that 20% of rate of return is easily possible with sequential SIP and DIP alone. Now, people definitely, this is a very high figure. When we see that we want a realistic figure, like if I say, if I want 50 crores, this is, wait a minute, 50,000, 5 lakh, 5 crore, 50 crores. And I need it at the age of 70. Today, if I'm 40, I'm not 40, if I'm not 40, I'm 45. But if I need it at the age of 70, that is, I have another 25 years of investment at a rate of return of 12%. I need only 26,878 rupees on a monthly basis. And I can easily make 50 crores by the time I'm 70 years old. So this is how that this is at the rate of return of 12%. But I am confident, even if I do not reach 20, I can easily reach 15%. So I need only 15,000 rupees to make 50 crores for the next 25 years only. Imagine if I had started this investment when I was a little more younger. Now many doctors are younger here and they have good amount of time in front of them. And if you're only 30 years of age, then you have this time in years, not 30, but 40. So if I continue this for another 10 years, just look at the figure which changes. It becomes, what is that? 225, but 2000 crores? Just mind-boggling, isn't it?
Sir, it is 5 crores, I think, not 50 crores.
So, and just by SIP and DIP, you don't have to even learn trading. Just by investment, you can make crores. But the game is to stay long term. It won't happen overnight. Those people who want to make money overnight should not come into the equity market. And they definitely should not be joining the WealthCon. WealthCon means long term. Long term means minimum 7 years. I thank the organizers. I hope I have been able to gel a few things together.
Thank you, Dr. Sirish. That was a wonderful, very simplistic, easy to understand, and very effective presentation on ETF, which is so popular but has lot of reservations and doubts among our attendees. And the calculator, I request you if you can post it in our group, that will be very useful for our
Yes, sir. I'll send.
members.
I'll be sending.
They can play around and they can themselves check how much they have to invest per month and what is the target of 50 crores to achieve, how many years and how much percentage was.
Sir, I'll send it as an email, sir. Please forward it on email because on WhatsApp, the formulas, they are not getting copied.
Okay, I'll send the email, either me or Dr. Harish Gopal, sir, you and then we can check out with our members. So there are certain questions which have come up. I request Dr. Harish Gopal, sir, and Sirish, sir, you can also read some of the questions and start answering.
The first question is, Sirish, sir, the first question is, do we get dividend in ETF also?
The ETFs, yes, sir. As I mentioned, the price of ETF is not exactly 1% of what the index is. It's always a little higher than that. So that includes the dividend prices. So you won't be getting an extra dividend in your account as the other share investment, but it is included in the price of the ETF itself.
Okay, sir. Now the next question was how to do a SIP in ETF that you have already showed. ETF Bs versus index mutual fund, which is good, already mentioned in your talk.
Yes, sir.
Please explain about tracking error.
As I mentioned, the tracking error is the difference between the returns of the ETF and the index. If the index is moving and if the ETF is moving in the same line, if there's not too much of a difference between the moment, that difference is called as a tracking error.
So the lesser the better.
The lesser the better.
The next question is return in Nifty Bs versus Nifty index fund. Will it be same or less or more?
It depends on the asset managing company. If the asset managing company's expense ratio is higher and everything, then definitely the returns will take a hit. So that is why we do the CTRLL analysis also. That will give us a lot of idea about which company is managing it in a cheaper price. And as we mentioned, as it has been found, that Nifty Bees is much cheaper. The ETF which is being managed by Nippon India ETF, Nifty Bees, that is got the least expense ratio as compared to other ETFs.
Question is, does ETF always follow index?
Yes, ETFs always follows the index.
The next question is, should we always invest in Nippon company only or other ETFs also we can
That's
invest?
what any company is fine as long as your analysis is sound and you go and follow the steps of CTRLL. Any company is fine. If you feel that has better liquidity, why not?
The next question is, how easy to sell ETF?
As easy as it is to buy, it is easy to sell as well.
Are there any
Unlike mutual funds, which require a little bit of time and exit loads and everything, that is not there in ETF. Just like
and also in mutual funds you will get it 1 plus 2 days or 1 plus 1 T plus 1 day. Here you get immediately.
True.
So are there any liquidity issues, especially when there is a crash?
Liquidity issue in the crash should not be taken as an opportunity to sell. Crash should be taken as an opportunity to buy more. So when you're entering, you should not be worried about crash. Instead, I think Makaran sir will be better equipped to answer that, because every crash
is
he
an
waits for
opportunity.
more opportunity to buy.
That's why I was putting in the group. Open your FDs to invest on Monday. Monday you'll see a crash again.
Monday
So
might
please
see a crash again.
explain expense ratio for ETF selection.
Expense ratio means any see when you go on to these value research online website, you can see that every fund has an expense ratio. Now, expense ratio, like if I have to buy 1 rupee worth, one rupee worth share or 1 rupee worth of the fund, and if the expense ratio is 0.4, that means I'm paying 4 paisa out of that 1 rupee as an expense to the managing company. So if the expense ratio is 0.4 for every 1 rupee, I'm paying 4 paisa, means 96 paise of my 1 rupee will be invested.
Next question is, right now I'm in loss in Nifty base. What I should do?
Add more tomorrow.
Okay, so our next question is, what should be the percentage of monthly investment to invest in ETF? That is asking the allocation between Nifty Bs, Junior Bs, Mid Bs, like that.
Sir, this is actually a very good question, because Dr. Gaurang Kadam sir, who is a master in Excel management, learning, he keeps doing some I think there's something called as, I don't remember exactly what he does, but portfolio optimization. Yes, he does portfolio optimization, that he does through a lot of calculations on Excel. He had showed us one, and it just blew our minds. But he keeps sharing every 3 months how and what should be the proportion of division, and we just blindly follow that. The WealthCon generally does not give tips, but this is how the tips are given.
No,
In the
what
sense,
is asking is the based on the risk profile, should I invest more in Mid Bs or more in Nifty Bs?
it should be, that's what, sir. The portfolio, sometimes you have to invest more in large caps, like Nifty Bs, and less in mid 150 Bs. Sometimes the investment changes to more in mid 150 Bs, depends on how it changes. That is called as portfolio optimization. But if you want to begin, I think you should stick to more in Nifty Bs, which is a little stable, and little lesser in mid 150 Bs. As and when you keep gaining confidence, you can keep switching your percentage division into all these things. Like when I started, I used to invest when I started with 1 lakh rupees of ETF investments alone. I started with 35,000 in Nifty Bs. Now my Nifty Bs portion has gone to 15,000, while my junior Bs and mid Nifty Bs have gone up to 45,000, just like that. So I keep
And
changing.
gold Bs also, little bit
Gold Bs as well.
Bs.
Gold Bs, yeah.
So, and then Dr. Lakshmi is asking, please suggest best ETFs to start SIP now.
I mean, the Nifty Bs, Junior Bs, Mid 150 Bs, Mon 100, Gold Bs, more than enough.
So it should be a mixture.
Yeah,
Makaran sir is telling 50, 30, 20.
50, 30, 20. 50 in Nifty, 30 in Junior, and 20 in.
All.
Sir, there are many questions. Please tell us briefly how to do SIP in ETF.
I think we should be having one video of how to do SIP in ETF. I think we can just share that video in
Share
the.
it. Okay, sir. Sir, any problem with daily or weekly SIP, better cost averaging or more expenses? Weekly versus monthly.
I think monthly should be good enough, sir. But many times what happens is in monthly you're not able to catch the cycles well. But that can be managed better with your this thing. What do you call adding on dips. When you're doing it monthly, you're putting in lump sum. When you're doing it weekly, you're dividing the same lump sum into 4 parts and doing it. Generally, does not give much of a change, but it increases your transaction costs.
And more headache for investing, sir.
Yeah.
And the next question is, what about silver, pharma, ITBs?
Silver ETF is fine. For gold bees and silver bees, you can divide, but going deeper into individual sectors is not really required because many of these sectors are also constituents of these major ETFs like Nifty bees and Junior bees. So
And they
majority
are
of
cyclical.
yeah.
Anybody wants to raise your hand and ask, please raise your hand and unmute your mic and directly you can ask the speaker.
Dr. Harish, one question for Dr. Sirish, sir. Dr. Ajay here.
Yes, sir.
Sir, there is a question, of course, has come in also to my mind. One of the slide you have mentioned that the index is showing 14-15% and the ETF is showing almost higher than index returns, say about 20% or 18% it has shown. And then there is a column where you mentioned TRI. So this ETFs, how do they get more than index
So
returns?
it is not that they've got more than index. It is just that the price of the ETF is including the dividends. No, so the price of ETF is a little higher, but the movement is same, just like the index. The percentage returns is same.
So what is
Sir,
TRI?
Ajay sir,
Yeah.
sir, Siri sir has that return of 20% includes SIP and DIP.
Okay.
SIP and DIP, and not only SIP like in mutual funds.
Okay.
That's
And
why
what
the
is-
returns are higher.
What is TRI?
It is total return index.
So do we track our ETF index purely or it is TRI, sir?
No, sir, we can just keep
Right.
for simplicity purpose, we can just keep tracking our Nifty index itself, sir.
Okay.
So there are certain questions. Should I stop mutual fund and start ETF?
If it is a regular mutual fund, definitely please stop it and start SIP in ETF. If it is a
They are
direct
asking
mutual funds,
direct index mutual funds.
yeah.
So the next question is, what is the minimum amount to start ETF?
That depends upon individual risk-taking capacity. But it is recommended that you do not touch your 6 months of your earning, that you have to keep it as a corpus for emergency funds. You should never be touching those emergency funds. And all the funds required for your EMIs and your school fees and everything, that has to be kept separate. Then whatever is remaining, divide that into debt funds as well as equity funds, because even debt funds are necessary. So it is recommended that whatever is your age, subtract that from 100, and whatever the figure comes, that much amount you should invest in equity. And if you are just a beginner, you can invest that entire thing into ETFs itself. So suppose if you are 40 years old, then 60% of your investable income should go into equity investment. But that is again a guideline. If you want to do 80% also, no problem, but always denote some portion of it into debt funds.
Again asking which ETF in which order, how much percentage?
That I think we can keep discussing more and more in WealthCon group or WPI group. I think a lot of answers will come there.
Yes, sir. Can emergency funds be parked in liquid base? Yes, you can
Yes,
park in
that
liquid
is,
base.
yeah.
Okay. Any other direct questions? You can unmute your mic and ask, or we can close the session. Ajay sir, over to you, sir.
Thank you, Dr. Harish Gopal. Thank you, Dr. Shirish sir. Wonderful session we had today and very learning points which we have got from you, an experienced person with a background of WealthCon teaching and learning. We are indebted to you for accepting our invitation and coming here, sir. It was real awesome session we had for F3 group. I request you to be there in the group in the WhatsApp. There may be certain questions
sir.
which may be coming on and off. If you find time,
No,
you can
definitely.
please post them answers there. It will be helpful and it will generate some more motivation and inspiration about investing in ETF and learning more knowledge, finance knowledge from you. I am on behalf of the F3 group, Pediatric Academy of Telangana, Indian Academy of Pediatrics, I thank you very much for joining us, and we expect you in future to help us and guide us, the doctors, in learning this subject from you, sir. Thank you very much.
Thank you, sir. Thank you. My pleasure. Thank you.
We can leave, doctor. And I
Hello,
thank
sir. Yeah, sir. Ajay, sir.
Pavan. Yeah,
Thank
please
you, sir.
close.
Thank you. Yeah. From Tashkent, sir. From Tashkent, Russia. So still, I'm just roaming the markets here, but still, I was able to listen to Sirish, sir. I know Sirish, sir, during my TMP days. So thank you, sir, Sirish, sir, for coming on to platform, which is done by Dr. Ajay Kumar, sir, and Harish, sir. They're the main lead coordinators for that. So thank you for being the part of this journey, sir. I
Thank you.
think many of the doctors here have definitely been understood the simplest and smartest way of investing. Thank you so much, Sirish, sir.
Thank you, sir.
And
Thank you.
thank Dr. Pavan for joining from Tashkent to our F3 program. It is wonderful. Dr. Pavan is our sheet anchor, sir. Dr. Sirish, sir, he is the during his secretaryship of the state PATS that we started this program, he is continuing to anchor our sessions. Thank you, Dr. Pavan. We can leave now. Satish, you can stop the recording. Thank you.